It was a financial rescue package on a scale nobody'd ever seen before.
We have taken a comprehensive approach. This is not a time for conventional thinking or outdated dogma, but for the fresh and innovative intervention that gets to the heart of the problem.
The Chancellor said at the time that putting up to £500 billion of taxpayers' money into propping up the banks would solve a big problem. It would start them lending to each other and us again. Back in October 2008, Gordon Brown was asked if he was writing a blank cheque by doing that. This is what he said.
I utterly dispute what you are saying. What we are doing is similar in one instance in the insurance-based scheme to what is being done in America, and nobody has made that claim about America. And I would urge you to be cautious in the remarks you make.
But while not quite blank, it now looks like the figure on that cheque's ended up pretty huge. According to the parliamentary money watchdog, rescuing our financial system from collapse set back the average UK family more than £5,500. Overall, the total support from the public purse runs to £850 billion, and it could get bigger. We won't know the final cost for years, but adding to the final tally are fees the Treasury's having to pay to get advice from investment bankers Credit Suisse. They were brought in on long contracts, paying them £200,000 a month, something that National Audit Office report has criticised. It's also revealed that just before being bailed out with billions of pounds of our money, the government thought RBS was doing OK, reporting that its capital position was reasonably strong. But it's not all criticism. The report does also say the government was right to support the banking system to stop the meltdown spreading further. But that line about starting the banks lending again, sorry, says the National Audit Office, but that didn't work out. RBS and Lloyds apparently aren't going to meet their commitments for lending £27 billion to firms this year. Peter Gray wrote the report.
There are comparatively few sanctions available to the Treasury to apply if if banks fall short. Clearly there are two reasons that could happen. One, whether the banks are willing to lend, and the other element is whether there are creditworthy customers who should receive loans.
All this on top of yesterday's news that RBS directors are threatening to quit if the Treasury imposed a cap on their bonuses. That, says the Lib Dems' Vince Cable, is unacceptable.
The government was right to insist that it should have a veto over these bonuses. There is now a general acceptance that bonuses paid in cash to traders doing high-risk activities are dangerous, and that it has to be stopped within government-owned institutions.
It now does look like the RBS board is backing down. But it surely can't be surprised that with figures like this out today, the government's closing the door on paying out huge bonuses to a bank its taxpayers partly own.